top Goldman Sachs analyst says the world is moving into a new super cycle. The global economy is moving into a new super cycle, with artificial intelligence and decarbonization being driving factors, according to Peter Oppenheimer, head of macro research in Europe at Goldman Sachs. Super cycles are commonly defined as lengthy periods of economic expansion, often accompanied by growing GDP, strong demand for goods leading to higher prices, and high levels of employment. This was characterized by interest rates and inflation peaking, before a decades-long period of falling capital costs, inflation and rates, as well as economic policies such as deregulation and privatization, he explained. Meanwhile, geopolitical risks eased and globalization grew stronger, Oppenheimer noted. But not all of these factors are now set to continue as they were, he added. The Russia-Ukraine war, tensions between the US and China largely relating to trade, and the Israel-Hamas conflict, which is raising concerns on the wider Middle East, are just some geopolitical themes that markets have been fretting over.
I think there are 2 points that I want to sort of emphasize. One of them is that the major super cycle that we've been in really started the last one in the early 1980s, when interest rates and inflation peaked at very high levels, and we saw 25, 30 years of consistently falling cost of capital, inflation and interest rates. But that period was also supported by very aggressive supply side reforms in economies, privatization, deregulation, lower corporate taxes, the collapse of the Berlin Wall and the Soviet Union, bringing down global risk premia, and of course the move towards globalization. And I think we are moving clearly into a different super cycle, one in which some of those factors can no longer be relied on in the same way. We're not likely to see interest rates trending down as aggressively over the next decade or so. We're seeing some pushback to globalization. And of course, we're seeing increased geopolitical tensions as well. Having said all of that, while those things should leave a lower pace of returns across financial assets relative to those in the last decade or two, as you say, there are some very other significant drivers which could be very positive. The combination of AI and its impact on productivity, but also decarbonization. They're 2 very different drivers, but both of which over the medium to longer term can be actually pretty supportive.
Well, we were talking about decarbonisation from the copper story on Friday, that there could be a copper super cycle coming. Yeah. But when we think about just the AI story first up, because that is the one everybody's focused on, some argue that, look, we're still in the foothills of this AI story, even though you've got huge valuations now in some of these AI stocks. There could be more to come because we've just scratched the surface on the capabilities here. What do you think, given you're now talking about this super cycle?
I think we are in really relatively early stages. We're in the innovation stage where the technologies are commercializing and becoming leverageable. But what we have not seen, and I think we will see a lot of in time, is new applications and services that are really based off these new technologies. And that's really when you tend to get the positive impacts coming through and the broadening out of its effect across the equity market. I would say the second thing is we haven't yet seen, and I think we're relatively positive that we will see, an improvement in productivity on the back of the applications of AI, which could be positive for growth and of course for margins. And I would say thirdly that although we have seen tremendous gains in some of the companies that are seen to be at the epicenter of these technologies, they're not really that expensively valued when you compare them, for example, to the dominant companies during the tech bubble, during the Nifty 50 bubble in the early 70s, during the Japanese bubble in the late 1980s, and they're already much more profitable. So I think this is a story that can run and have quite a big impact for still some time to come.
While current economic development should theoretically lead to the pace of financial returns slowing, there are also forces that could have a positive impact, namely artificial intelligence and decarbonization, Oppenheimer said. AI is still in its early stages, he said. However, as it is used increasingly as the basis for new products and services, it could lead to a positive effect for stocks, he said. The hot topic of AI and productivity, which has often gone hand in hand with debates and concerns around human jobs being replaced or changed, will likely impact the economy. Despite AI and decarbonization both being relatively new concepts, there are historical parallels, Oppenheimer said. One of the historical periods that stands out is the early 1970s and early 1980s, which he said were not so dissimilar to current developments. Elevated inflation and interest rates were perhaps more structural issues than compared with now, he said. However, factors including growing geopolitical tensions, rising taxes, and enhanced regulation appear similar. In other ways, current shifts can be seen as reflective of changes even further back in history, Oppenheimer explained. Modernization and industrialization fueled by infrastructure and technological developments alongside significant increases of productivity mark this historical period. Crucially, these historical parallels can provide lessons for the future, Oppenheimer pointed out.